Ladies and gentlemen, please welcome your panel on Filling the Global Infrastructure Gap, moderated by CNBC's senior national correspondent, Brian Sullivan.
Hi, everybody, and welcome. Thank you very much. I mean, what a day, right? A $2 trillion discussion in the White House about infrastructure. It's finally feels like we're getting somewhere, slowly chugging. We think we can. The question is, and what we're going to talk about on this panel is, where are the gaps? I mean, if you spend $2 trillion here, a couple trillion overseas, starts to turn into real money, doesn't it? But the point is, where do you put it? How do you get return? What kind of returns can you expect? Where's the best use? And can you also manage oftentimes conflicting goals, environmental, social, financial? So we're going to dive into all these things. Let's get going. Let's introduce a really great panel. I mean, very diverse, very smart, lots of history, and can come at it from different angles. We'll start over here to the right is Dave Bohigian, Acting President and CEO of Overseas Private Investment Corporation, former Bridgewater management team. Ray, are you into meditation like Ray, or just
a little bit? Yeah,
a little bit.
Radical transparency we'll do today.
It's amazing, right? We're gonna fill the meditation gap.
Yeah.
Jim Yong Kim to my right, a man who needs no introduction, but I'm going to give him one anyway. Former president of the World Bank, former president of Dartmouth University. Can my kid get in for less than $50,000? Oh, that's a different panel. Sorry. He is partner and vice chairman of Global Infrastructure Partners. It's going to be a great conversation. To my direct left, we have Angela Rodell, CEO of the Alaska Permanent Fund Corporation as well, in from Juneau. Only state I've got left to visit. I'm going to come see you, by the way. We're going to do it. It's going to be great. Ray McGuire, Vice Chairman of Citigroup, Chairman of Citi Banking, Capital Markets, and Advisory. And on the far end there is Hiromichi Mizuno, Executive Director and Chief Investment Officer, the Government Pension Investment Fund of Japan. They manage and oversee a cool $1.4 trillion.
Probably have 1.6.
Oh, it's a good month.
A little difference, though.
Thanks for coming.
Yeah, thank you.
So let's dig right in, Angela. I'll begin with you. When you look at projects, do you shape your projects and your investments based on need, financial return, social return, environmental return? Do you have to rank them? And if you did, how would you rank them in how you pick and choose what the Alaska Permanent Fund invests in?
So we look solely at financial return when we're looking at our projects. Some of these projects will generate a social and environmental, but that comes, that's like gravy to us because that financial return is really what the Alaska Permanent Fund was created to invest in and generate financial returns only without respect to anything around that.
That's the mandate.
That is the mandate.
And so what does that for you when you look at the infrastructure gaps, where to invest going forward? What meets those goals? What kind of ROI can we realistically expect on some of these infrastructure projects?
Well, I think it means that we're looking at something very different. It's very hard for us to find stuff in the United States. The United States has a very different market. It's nice to hear about President Trump's effort to continue to bring infrastructure up. But for a return, we need something that is market-based, that is much more a hurdle rate in excess of 7, 8, 9% return on investment for infrastructure. And so what we're looking at is we've found opportunities outside the United States. There are opportunities around the world. They tend to have less regulation or less mandates around them in terms of getting them developed. And there's more what we call brownfield opportunities that are used to having investment from private investors such as ourselves into that to lift up the capital improvement.
You know, Dr. Kim, the most depressing flight in the world is to take Singapore Air from Changi Airport and land at Newark and then get on a United flight. Why does the rest of the world seem to do infrastructure so much better than us?
Well, some places do infrastructure really well. I mean, Changi,
not everywhere, but a lot of places.
Some places do. And let's go back and first you talked about the gap, right? So what's the gap in developing countries? The gap is something like $2.7 trillion a year. That's just the gap in emerging markets. Now, so many places have just transformed their airports like Changi, but not everywhere. I mean, it hasn't happened in China, for example. They haven't done the same kind of privatization of airports in China as they have in some places. And you can tell that some of the airports that are working most effectively are more like shopping centers, right? And so the way I look at it is, if you step back and ask the question, is there enough money out there to fill that $2.7 trillion gap in infrastructure investment in just emerging economies? And the answer you hear a lot, money is not the issue. But now that I'm in this new role, money actually is the issue, in the sense that you have to go a long way to convince people that the return that they can expect, given what they conceive as the risk in emerging market, balances somehow. But I'll leave you with one story. So I was doing a speech at the major infrastructure investor meeting in the world. It's in Berlin every year in March. And I asked a room of about 400 people, how many people here think that the policy environment has a direct impact on your emerging market infrastructure investments? Everyone raised their hand. And then I asked the second question, how many of you know what a development policy loan is from the World Bank Group that's actually shaped to specifically change policy? And literally, I said, I just asked a development policy loan. 5 people raised their hands, right? So I think the issue is that there's a lot of interest in emerging market infrastructure. There's clearly a sense that you can get great returns, but there's a huge mismatch in the understanding of the countries, how to make them better, how to change which countries are better than others for investment, and the way that asset managers and asset allocators are thinking right now. So we've got to get a lot more information and education out there, and then I think that we can fill that gap and investors will get very good returns and have huge social impact at the same time.
But Dave, that's not just a funding gap; that's a knowledge gap, right? I mean, you guys at Overseas, you're changing the name of your organization, are you not?
Absolutely, we're going from the Overseas Private Investment Corporation to the new Development Finance Corporation.
I assume part of that is because you want people to understand what the options are that are out there.
Well, part of it is because people thought we were an oil cartel. So once you get past that, the options
Hey, what
are...
panel? Hold on, OPEC.
I'm the wrong place. No, we've been helping to catalyze private sector capital for almost 50 years, similar to what the IFC does at the World Bank. And we truly lean on the work. I've been all over the world for the past 15 years holding up your doing business indicators. And it's no accident that when I go to Georgia that really thinks about this at their highest levels of government, the Prime Minister and others, to create a race to the top and be in the top 10 of economies. We're investing more per capita in Georgia than anywhere else in the world for infrastructure. We just put money into a port there. And so the Overseas Private Investment Corporation and the new DFC is redoubling the United States' efforts to help build infrastructure around the world. That could be toll roads, it could be hospitals. We also invest in private equity and really helped invent political risk insurance. So it is helping investors think about the world in a different way and helping them access opportunities they wouldn't otherwise toward development goals.
We love, Ray, beautiful, shiny new things. I mean, my wife, I went to Dubai and she said, what was it like? I said, well, if I dropped my pizza upside down, I might consider picking it up and eating it still. Now, maybe that says something bad about me, but it was also the airport was spotless. It was shiny. It was new. The Shinkansen in Japan is amazing, but can we make money doing these things, Ray?
Let's step back and look at this globally, and we've been fortunate to be involved in a number of these projects, partnering with our partners at the World Bank and OPEC and other of the global institutions. There are 3 broad dimensions by which we analyze these projects, and I reference them as ALS. A is the asset part, and the asset is whether or not it's a core asset or whether or not it's a new technology. The L is life cycle, and that whether or not it's an existing project or whether or not it's construction. And the S, importantly, is sovereign. And the sovereign is separated between developed markets and emerging markets. If you look at the need that Dr. Kim referenced, half of that need is in the emerging markets. And when you go to the emerging markets, then you have to decide how you will finance in the emerging markets. And the challenge you have in the emerging markets is $3.5 trillion, or 3.7 as Dr. Kim referenced, were spent last year. Of that, $335 billion solely was spent with private capital. The remainder of the funding comes from the country balance sheets. Then you have to go a little deeper and you look at each of the countries, especially in the emerging markets, and asked, how do you fund infrastructure projects in local currency without some kind of foreign exchange support? And so you will see the vast majority of the projects that have been funded, and you talk about the pristine airports, the reason that you have so many of the infrastructure project funds being funded through airports is because they're dollar denominated. And as a result of that, you can get a lot of the infrastructure funds and a lot of the development banks who are prepared to finance large infrastructure projects. So the vast majority of these, construction with life cycles that are definable, with assets, the risk of which you can define.
You said core. Can you just quickly, how do you define core?
Core, well, let me give you core versus new technology. The largest new technology is the 3.5 billion euro wind farm project that was sponsored by one of the largest infrastructure funds. That is new technology. Core is, as you think about infrastructure divided between social and economic, the economic part of core will be airports, toll roads, bridges, highways. Of those, when you think about airports, you can collect a toll in the emerging markets, which can pay for and generate a return. You can generate fees out of airports, either through the airlines or through the concession stands. When it gets to some of the more aggressive forms of financing, if I get to utilities in emerging markets, the ability to finance that is dependent upon the offtake of a power purchase agreement, as an example. And the more confidence that investors have in the credit rating of the offtake, the more ability it is for private capital to participate.
You know, Hiro, your country, Japan, is the head of the G20. How do you make the G20 vis-a-vis Japan and the trillions you have focus and make developed country infrastructure investing a priority?
Can I just interject once before you answer that? Just a mistake that I made probably 2 years ago having dinner with Hiro. Upper hills of Beverly Hills, you know, it gets a little windy and we're getting to know each other, and I say, so what do you do? And he says, well, I have a fund and I invest, you know, I got a kind of $1.3 billion. I thought I heard $1.3 billion. He says, no. It's $1.3 trillion. $1.6
trillion, apparently, right?
We go from $1.3 trillion to $1.6 trillion. If there's size at this conference, he represents size. So, Hiro, sorry.
Thank you very much. And size is not always the luxury to have. We reported $160 billion loss during last September and December. So we lost as much as one of the major public pension funds in the U.S. So sitting on the big fund is sometimes comes with a pain, but it's very important for us to have a very well-diversified portfolio. And you know, first of all, GPIF. Before I answer your question about the G20 Japanese Presidency, GPIF started investing in the infrastructure just over the last 5 years. And originally, the need came as the world getting into very low interest rate environments, and we cannot depend upon the fixed income or bond investment to yield return or like create the consistent cash flow. And where, you know, infrastructure, particularly core infrastructure, appear to be very attractive because it's the other stable and generating a cash flow. So for most of the big asset owner, including us, we got attracted by infrastructure investment because we thought it's going to be a good alternative to fixed income portfolio.
Is it?
Well, it is, and but that's actually created another problem. Like the Jim has been struggling, like you know, for the investor who want to invest into the infrastructure, which is cash generative and stable and safer. You know, the more need for the infrastructure investment actually residing in the developing countries, and a developing country infrastructure investment by definition is going to be riskier. So people struggle to use it as an alternative to fixed income and you know, the stable investment. So that's how we think the infrastructure is very important, and I think we are trying to expand our boundary to be able to invest more into developing market and greenfield investment. And coming back to your question about G20 Japanese Presidency, I attended the other investor forum, which was organized by World Bank at the Buenos Aires as a side event to the last G20. And the big topic was how to finance the gap and how to create the infrastructure in developing countries. And Japan is going to continue discussion on that one. And as you can imagine, there's some difficulty in the discussing about the climate and those sustainability-related agenda, but Japan is going to raise the discussion on the high-quality infrastructure. We should have have focus on the environmental, social, and governance issues to be sustainable. So we will continue to work on it, and it should be on the top of the other finance ministers' meeting agenda. And I'm hoping that that we will build on what has been discussed. But we share all the frustration. We have been talking about that for the decades, but things are not really happening. And that's probably the main theme of this panel discussion.
Well, we got to make things happen. We got people at this conference that can make things happen. And I'm glad you're talking about high quality infrastructure, because the East Coast of America has got the market cornered on low quality infrastructure, so you're settled. Jim, let's answer this. I should have asked you this to begin. Is infrastructure an asset class?
Well, we've talked about it for a long time, as Hiro said, but not quite yet. Certainly not infrastructure in emerging markets. And what I knew when I was at the World Bank, and know even more clearly now, is that a lot of investors are waiting. They're waiting for countries, for example, to do project preparation and present the project, or they're waiting for somebody to jump in and take ownership of a particular project over its entire life cycle. And so that's what we're hoping to do, stepping forward. And somehow we've got to ignite people's imagination to say, well, what if you could find something like an airport or something like energy or other things where you have a reliable power purchase agreement, for example, where you have a reliable government, where you bring together forces like in the multilateral development banks that could give direct budget support so that they could change their policy environment to make it more amenable. And you put all these things together: political risk insurance, credit enhancement, partial risk guarantees, all the different instruments, even currency hedges, which is one of the things my former colleagues, Stephanie and Jingdong, are here, working on things as complicated as currency risk mitigation efforts. If you could put all those things together and then show that you can get a very good return and mitigate risk in ways that again, people just are in the investment world can't imagine, then I think you could move toward aggressively building more of those kinds of projects, because I think you can get a return. I think the tools for de-risking, Ray mentioned as well, OPEC does them as well. Those are very underused. If you could use those and then ignite people's imagination, then all this talk that we're hearing. I was on a panel at the World Bank last year where one of the leaders in this world said that there's 46 trillion under management by people who are committed to impact investing, which just exploded my brain because we haven't seen anything like that.
It's a big number.
I think it's 46 trillion under management for people who have ever thought in their dreams or at some point about impact investing. But I think if you could put those specific examples together, you could create the asset class.
There's a lot, Dave, there's a lot of hedge funds and stuff like that here, and forget about everything else we talked about. Infrastructure is cool, right? You want to go to a nicer airport, not a dumpier one. But a lot of the members that come to this conference, they want to make money, okay? Yeah. Equity markets, valuations, if not high, they're sort of high-ish. Bonds have been overbought, oil, so these hedge funds are now looking at different pension funds, looking at different opportunities. But there has to be a return there. And I've had conversations on infrastructure, Dave, where people literally have been on panels that have said, we can't look at infrastructure like it's a financial asset because you're talking about lives in developed countries. Right. We need waters and wind farms. And how dare you look at it like there has to be a financial return? But if there's not, the hedge funds and the Angelas of the world aren't going to come in because their mandate is that. What's an acceptable and expected rate of return? Can you make 20%? Is 8% good enough? 4%?
Well, Jim could answer on behalf of his LPs, I know, but I'll tell you what's not acceptable. I can pull together quality infrastructure and your pizza eating habits and pristine airports. I've been to an airport that's unacceptable returns under any circumstances. The port in Sri Lanka gets a lot of attention in the world, but what's not known as well as the airport there that the Chinese built, employs 700 people for $200 million investment, and there are 0 commercial flights. Right? Nobody comes to the airport. When I came into that airport, the ground crew and the pizza concession and everybody else met me at the airport because they hadn't seen anybody that day. And that's the wrong way to do development. That is the white elephant defined. And so I think investors and countries need to consider rates of return. They also need to consider their own sovereignty. They also need to consider the environment and transparency and anti-corruption measures, upskilling their local workers, and making sure these projects are built to last. So I'll leave the private sector to acceptable rates of return, but I know that's not acceptable.
But that's a perfect example that the sustainability of these investments will be if they're commercially viable. If they're not commercially viable, they'll be one-off investments. And so, this is certainly what we're looking at it. And I, if you read the papers that were covering the Belt and Road Initiative in China, President Xi seemed to be saying that he wants to do more of the Belt and Road Initiative through commercial commercial investors to make sure that you're doing something that will provide a return. And can you get 15 to 20% on emerging market infrastructure and meet the 8% hurdle rate that the Alaskans want? I think there's no question that you can do it. There's just no question.
Well, and I think going back to your point, Jim, too, about ownership, and let's bring it back to the United States for a moment, because we've been talking a lot about what we could do outside the United States, but when we look at the needs inside the United States, what's preventing the infrastructure development and investment here in this country? And it's that ownership. When you have ownership by a local government, a state government, and a federal government, and then you have a lot of interested parties that have sustainable requirements and things like that, you raise the cost of that investment, that when we look in Alaska and the infrastructure needs in Alaska, you can't generate enough revenue to ever cover the cost of that infrastructure development. Ever. Because you have 700,000 people. And they're spread out over a geographic size that goes from Minnesota to Florida, from California to the East Coast. And so we have to think about this differently. And one of the things that has happened in this country is the creation of the opportunity zones. And there have been panels on the opportunity zones. But think about opportunity zones in the context of infrastructure investing in this country. And now here's a way to defer capital gains. Here's a way to create private investment during a risky phase on greenfield projects in a place like Alaska that needs to have roads, that needs to have pipelines, that needs to have ports in order to develop and meet the security needs. The Arctic is opening. Climate change is real. The U.S. is an Arctic nation. Alaska is on the front of that piece. And so now you want to take it and you want to think about it, well, maybe there's a way. We have opportunity zones in Alaska on the North Slope. We have opportunity zones in Western Alaska for ports. The Coast Guard is building another icebreaker. So there is need, there's demand, there's an opportunity where you can use the tax code that has been created through the opportunity zone mechanism to create an infrastructure investment in the United States, have U.S. rule of law, have U.S. dollar exposure, and still get the returns. There may be a delay on those returns because these are greenfield projects that have a long build life, a lot of environmental.
But you said at the beginning that it's a financial goal, it's in your mandate. Is there a minimum acceptable? Forget about Alaska. Like, let's just move out of your home state because you guys are unusual up there. I mean,
we are.
There's more bears than people, so they've got their own infrastructure plan. Okay, is there a minimum rate of return that you will accept?
A minimum rate?
I mean, when you look at projects, is there something you just say it's not enough, it's not worth our time or our money?
You're
You're not going to expect 20%. I get that, but there's got to be some kind of return on invested capital you look at and go, this is not worth our time, not worth our money. I'm sure you get a lot of stuff that doesn't make it.
Right. No, and that's a fair question because even though we're not a pension with a required liability, we do have return bogeys for the fund and for the investment themselves. Anything below 5% is probably a non-starter for us. At a minimum, that's it.
Ray, same question to you. I mean, is there a level with Citigroup is just like, you know what, it's not worth it?
I don't think that's a question necessarily, at least in the developed markets, regarding returns. There's let's call it between 175 and 200 billion dollars of capital, dry powder, with infrastructure funds. The limited partners are trying to identify projects that are going to generate mid to high teen returns. If you look at the successful infrastructure funds, many of them have been able to generate those kinds of returns. So it's not clear to me that the returns are the issue. I think you will, given the amount of capital that is being raised, if I look over a 10-year period, the dry powder in 2008 versus the dry powder today, it's gone up by 5 or 6 times.
When you say dry powder, Ray, it makes me, how do we get it wet? I mean, it makes me think like either they can't find projects to invest in, or they just don't have the risk tolerance, or the policy mechanisms aren't in place in a developed market or an emerging market.
Well, so it's actually, let's pause on one of the points and let's identify infrastructure in the U.S. Infrastructure in the U.S. is in large part state and local, right? The federal government funded infrastructure, and the ownership of infrastructure in large part is done at a local level. Infrastructure projects are all local. So it's not clear to me that there is, from a policy standpoint.
Well, I think I would push back a little bit on that, though, because when we think about airports in the United States, they are owned at the local level, but the FAA, the federal government, has a huge say in what happens and how.
From a policy standpoint, from a funding standpoint,
yeah.
So look at how federal infrastructure has been funded is through a gasoline tax in the Highway Trust Fund, which today is being questioned regarding its how it's capitalized. Today we come out with a plan to invest $2 trillion, so to speak, of funds. I got $13 trillion worth of infrastructure, 85 to 90% of which is owned locally by states and local governments. The funding that takes place, other than for some of the large airport projects, LaGuardia being one, is done on a private basis. I look at the project bond market last year, it's a $300 and some odd billion market, down from 417. So the answer is you can generate the returns, and there's enough capital, policy, the ability to get these projects greenlit, very important.
Hero, there's a lot of people at this conference who would like to have some of your 1.6 trillion and maybe 1.8 by the time this panel's over.
Can be 1.4 though.
Already
That's the problem.
Take us through your decision-making process on how you choose to invest.
Well, we use the other external money managers to find the opportunity because we don't have enough bandwidth and resource to select the enough project for $1.6 trillion. But I think the struggle, Angela's struggle answering your previous question really actually highlight why we are not moving the money into emerging market infrastructure. Because look, let's say if we are looking at infrastructure investment in the United States, we probably going to ask for very comparable return to, muni bonds or like a treasury bond, because we can understand the risk associated with that investment. So, in the developed market infrastructure, we have comparables so that we can answer what kind of return we are looking for. The problem with the emerging market infrastructure is, everybody says, oh yeah, if we can find an investable product, project or bankable project, we want to invest. We have enough dry powder to waste, or deploy. But in reality, we just don't have a comparable, right? So when I'm asked, Jim asked me that question before, what kind of return you are looking for? 20%, 30%? I don't know, because the risks are very different from one project to another. And one of the panelists which I joined at the IFC spring meeting this year, she's the private infrastructure manager. She said people overestimate the risk of developing market, developing country, the infrastructure investment, because historical default rate is much lower than the same of the developed country, which sounds counterintuitive, but that's actually the really highlighting the issues, because investor only invest into super safe project in developing countries, right? They cannot get their heads around what's the fair risk return combination when they invest into the developing market. So, I think we just need to have more comparables and we need to have more clarity. And even if we have much lower default rate, we have much more uncertainty how much money we can recover in a default situation. We have very less faith in the legal system, bankruptcy court in the developing markets, and it's very difficult for us to really get the strong grip on the stranded asset once it's default. So all those kind of things still doesn't make sense to us, and none of us, I never met any our peers, like the other asset owners, who has the answer to that question. What return we are required to make an investment in the developing countries, and that itself is a real challenge.
Great.
Well, the question that you have to address there is who the investor is, right? In the emerging markets, and David, you should speak to this because you have a number of projects, and Dr. Kim had a number of projects. In the emerging markets, the financing of a lot of these projects are done on the country's balance sheets, along with the support of a lot of the development bank.
In local currency
In local currency, and the challenge you have is in local currency, how you finance at 6 or 7% in local currency if it's not backstopped by a private institution or one of the development institutions. It's very difficult to do that, and as a result, the comparability in emerging markets is difficult to establish.
Yeah.
Well, I think that's exactly right, and OPIC's been providing political risk insurance as well as project finance to sort of de-risk that for investors, whether that's airports in Ecuador, toll roads in Colombia, or power plants in Togo. But I wanted to ask a little bit different question, Brian, if I might. Would any of your investors accept impact as a trade-off for returns? Because we're talking about ESG. That's a no-no right there, right? We're talking about
Angela's
ESG.
got a mandate. She can't. Right?
Yeah,
I mean,
right.
But I just think that that's the wrong path to go. That if we want to create emerging market infrastructure as an asset class, to ask people to make a compromise is dooming the whole industry to failure, I think.
Right, so when we get ESG panels here and everything else, it's only going to be a matter of investors demanding that, but they're not right now, at scale.
If you look at the early efforts at impact investing, first of all, they're extremely small, and the way that they were characterized is, well, impact you can do impact investing, but it has to be subsidized and the returns will be lower. Right? I think that's just a guarantee that it's going to be not sustainable. So for me, I think the key is really digging down. As Hiro said, there's just an information gap. As analytical as some people will be about the difference between companies that they're investing in, you talk to people about Africa, and generally they see Africa, and these are some extremely sophisticated investors. They see it as one risk pool. And so for those of us who know the continent well, to say that Rwanda and Burundi, neighboring countries, have the same risk profile, it's just crazy. It couldn't be more different. But somehow that information turned into commercially viable infrastructure investments, and then used as a way of demonstrating that we can de-risk these investments, they can provide good returns, and it's an asset class worth investing in. We still have a ways to go. We don't have enough really good examples of how you do that. We're beginning to have some. Energy in Egypt is a great example that the World Bank Group was involved in, that has gone from an initial investment that had to be made on the government's balance sheet to now huge amounts of crowded in private capital. Those are the kinds of examples we've got to get out there more and do on a larger scale.
But Dave, and you have an example of this. I mean, listen, a lot of people in this room are extremely smart and math-oriented. And so when they structure things, they want that clean number. I need X percent. They want to factor everything down to a math problem. But you guys committed at OPIC $1 billion to a Women in Africa program, $350 million direct, $1 billion overarching, a lot of microfinance. How do you make those? Is there a calculation? Or is it just literally, here's the money, they need it, and we'll figure it out later, or it'll figure itself out?
Right. Well, we get paid back, right? We are not equity investors who are looking to maximize returns. So when we launch our 2X Africa initiative, it's for advancing development goals as well as advancing foreign policy goals. And when Ivanka Trump goes to a textile facility that employed 5 women when USAID invested in them. And now there's 500 disenfranchised women who work there and have lunch there and create communities and training there. That's part of the return that we're looking for. And I go to different conferences about impact investing where the conversation is different, right? So that's where there's a tipping point into people doing real math. You mentioned earlier I worked at a hedge fund. There was absolutely no consideration of anything but returns there. And so for many investors in the room, that's true. So we need to figure out how investors and their limited partners and retail investors are going to think about ESG as a premium.
Can your current world exist with Angela's world? Maybe we need both.
Well, I think there's data out there that
pure
say,
financial, pure
yes,
impact?
Because I think women empowered companies, the data is starting to show they perform better.
Well, I don't
companies
think
that take
those are
ESG into
mutually
account
If I
perform
can,
better.
Hiro said to me once, and it just always stuck in my brain. He said, the GPIF has to think about the 22-year-old Japanese man who just entered the teaching workforce, because we have to secure his future as well as get returns on a short-term basis. And so one of the things you're seeing in Germany, for example, I was just there, and the Chancellor Merkel and President Macron and others have identified development in Africa, or the lack thereof, as a fundamental risk to life as we know it in Europe. And they've said, you think the Syrian refugee crisis had an impact on European life?
4 billion people in Africa by the end of our lifetime needing a job.
Needing a job.
And the world is heating up, and it's getting hotter and harder to make a living.
And everyone's going to have a smartphone very, very soon, and they're going to be able to see what life in Europe looks like. And so, to what extent do you then say, okay, so we may not be able to reach an 8% or 9% hurdle rate on infrastructure investments in Africa, but what about 5%? What about 6%? My hope, because I think it's hard to imagine that you're going to build all this infrastructure in Africa and get 15 to 20%, 9% hurdle rate, everything will be fine. I think in places like Africa that needs it so badly, we might have to think differently. But if we can talk about a 7 to 10% return with a 5 or 6% hurdle, and we can do it in a way that we're managing the risk, my suspicion is certainly that some of the European pension funds and sovereign wealth funds will be interested in it, and it could be that it's not that it's impact therefore no return. It's just a bit of a lower return, but that you'll because it's addressing such a critical need that will affect the long-term sustainability of the way of life of a country, or Hiro's ability to provide for the future of the 22-year-old. That more investors will be interested in those kinds of investments as well.
Asset allocator, let me put that this way, always compare which opportunities are better, on a risk-adjusted basis. That's why, as you mentioned, lack of compatibility or comparables make our job very difficult from asset allocator perspective. And the other thing I have been challenging is the notion of like ESG and financial returns are mutually exclusive. Because, in any companies you work for, now corporate executives are required to make a financial profit at the same time, not harming the environment or contributing to society. So the one, one leg, or one bottom line approach is no longer feasible in any business. Right. And my argument is why asset management industry are special. We should have up to bottom line, but we really cannot compromise return because of the impact. Mm-hmm. But on the other hand, I've been arguing was, sustainable development goals. It's very difficult for me or Angela to put the money to achieve sustainable development goals. But if you look at from the other angle, if we fail to achieve sustainable development goals in 2030, what kind of global risk our portfolio will be facing? So risk approach is much more sort of feasible for asset owner or like a fiduciary investor to take into our consideration. And the social impact or impact approach or opportunity approach will make it much harder. So I think the other asset manager or some philanthropy or endowment, and I always tell the other Jim, when you are the president of the World Bank Group, I'm jealous because you can focus on to do something good for the society. we have to make money at the same time.
Yeah,
So
well, look,
my job is double difficult.
I can't picture Ray in a meeting and going in with his management at Citigroup and Michael Corbat and whatever and saying, well, we don't know if we're going to make any money on the billion, but it's the right thing to do. That ain't going to work.
Yeah, but Michael's been great on this issue. Mike's been great on this issue. I mean, Mike's been trying to explore ways to work with the World Bank Group for as long as I've been there in trying to see, well, how can we, maintain our fiduciary responsibility and still, have an impact. And I one of the things I'd say is those conversations are critical because a lot of decisions are getting made with bad information. One of the things we found out, when I was at the bank, we were working closely with Larry Fink and BlackRock, and what we learned was that BlackRock was paying people to scrub our data at the World Bank Group and then try to find ways of making it relevant in their fantastic Aladdin system that monitors risk. And so we just said, well, why don't we just work together and find ways for us to give you much better ways of analyzing that data so that you can include it in Aladdin, which is now used by many different investment groups, with the idea that getting better information about the differences, for example, between Rwanda and Burundi would help asset allocators, asset managers, think in a different way about investing in developing countries. So those conversations are really critical. And just because you mentioned Mike Corbat, I used to be with Mike, twice a year because we constantly were talking about ways that the Citigroup and the World Bank Group could find ways forward together, as with Hero. I think that's really a key. You use every single tool that's available, including the ones that the new U.S. organization is going to have. And because let me just say, look, the problem of instability, for example, in Africa, because people can see how the rest of the world lives, and they see that they are completely, isolated from those opportunities. The things that we're going to see in terms of fundamental changes from climate change, these things are not, long into the future. They're happening right now. And so, if we have to increase the pace at which we try to do things like turn emerging market infrastructure into an asset class. We don't have time to waste, in my view. Yeah.
So I would say thank you, Dr. Kim. We have attempted to be at the forefront of the ESG initiative, which is more than an initiative. It is a necessity. It's a global necessity. So we've had the honor of working with David and Dr. Kim and Hero, and we will continue to do that on ESG, on equity, gender equity, global citizenship, first green bond, or amongst the first green bonds. So we've been at the forefront of this. One of the observations I would have is we've been describing the necessity to generate commercial returns and whether or not this is a commercial asset class. The other question that we should attempt to address is last week there was a convening in Beijing, which is the second Belt and Road Initiative, 5,000 leaders, 150 countries, and 37 leaders, heads of state, all describing the Belt and Road Initiative that Xi Jinping has outlined, starting in 2013, which encompasses 60% of the world's population and 40+% of its GDP. Ask whether or not infrastructure is a political asset class or a commercial asset class, or both. And to the point that you made, David, about the experience you had in one of the remote geographies, one of the emerging geographies, where there are 700 employees and a de minimis number of flights that are financed by China, ask how the global competition is looking at infrastructure as a class. If you get that many people convening in the Belt and Road Initiative, which is not only for new technology, which has to do with 5G, but it also has to do with existing technology, which are airports, toll roads, and ports, which are strategically important as an economy, ask whether or not our colleagues in the East are looking at infrastructure the same way that we're looking at infrastructure.
Yeah, and it's an interesting problem. I mean, anybody here, I'm assuming, live in the New York, New Jersey area? Yep. And we talk about this third tunnel to Manhattan for the trains. It's too expensive. Well, when the one tunnel goes down, as it probably will, and everybody who lives in New Jersey can now not commute into work because Amtrak has said they're not reducing their capacity. New Jersey Transit's capacity into Manhattan will drop by 75%. Wow. Did you know that? On the Northeast Corridor, if one of those tunnels goes down. That's economic doom for New Jersey and for New York in many ways. And I bring that up, A, because I live on the Northeast Corridor in New Jersey and I want my house value to stay up. I don't want it to collapse. But it's one of those situations where we talk about spending, it's too expensive. But if we don't do it, the cost is going to be so much larger. But Angela, it sounds like when you guys do your calculus, literally, advanced math, how many projects are just simply not doable for you? You just can't do it because you are representing the long-term welfare of the state and the people of Alaska.
No, there's a lot of projects I think that are in that, and that's the struggle that I think you hear up here on the stage is how do we think about that? How do we get creative? Where do we find mechanisms? Because we have a long-term horizon in perpetuity. We want to invest. These things are important. And so how do you capture the value, that economic value you just talked about, into the equation, into the return equation, and how much does it mean to the bottom line of getting these investments put into place or these assets created? And I think that's ultimately the challenge, is that we all know that there are assets that need to be created, that need to be funded, and government has to be a partner in these things, in figuring out where is it that they can reduce the cost to the investor. And I don't mean financial subsidies necessarily.
Yeah.
I'm talking about, can they streamline the regulatory hurdles that you have to jump through to get this built? Can they streamline the coordination? And because when it takes 14 years to get the environmental permits to build an additional runway at SeaTac, we have a problem. And so you have to think through how are we adding to the costs of the initial investment? What is it the cost of concrete, or is it the cost of permitting, or is it all of it that's making it too expensive for the people of New York and New Jersey? Because having lived in Manhattan for 15 years, there should be a way to make that doable. And the tolls don't have to be $30 one way to make it doable. So
well, they're getting there anyway. They're getting there anyway.
So, but what is it driving those costs?
I don't know. Last year, Dave, I did a fireside chat with then Speaker Paul Ryan, and it was an hour long. I don't know if anybody here was there. We did an hour long. It was 2 years ago, whatever it was. My brain's getting tired. And we were talking about a little bit about infrastructure, and he said, I hate public-private partnerships. It's corporate welfare. We'll never do that in Wisconsin. I can't stand them. Are public-private partnerships corporate welfare?
Not from where we sit. OPIC won't go into projects unless we're truly catalyzing and being additional to the private sector. So we try to make sure that we're investing in projects like in the Quito airport I mentioned earlier, where they said, but for OPIC, this project wouldn't happen. So I think that's an important part. You're not trying to remove the private sector. We're working with great partners like Citi to crowd in capital. And when the U.S. government puts a stamp of approval on it through our great due diligence process and our strong monitoring, we think that has a ripple effect on these externalities that we're talking about, that companies and countries see, wow, that's a place that you can invest. So we think the private-public partnership really has worked across the world.
You agree, Dr. Kim?
Oh, yeah. I mean, look, I think there are lots of examples that you could point to that may look like corporate welfare, but I think those two are not very sustainable. I mean, because that you'll get a public outcry against them, just like you've heard from Representative Ryan. But look, those of us that worked in academia, and I did that also, and people who work in the world of sort of global development, we tend to think that just presenting the counterfactual, that's what you just did. If we don't do this, then this will happen, right? That seems to be so compelling to us, but it's really not compelling to people who are making investment decisions.
Hasn't worked in New Jersey,
which is why there could be problems. But I think the other the reason that I'm doing what I'm doing now is that I came to the conclusion that we just got to put the actual deals together. We have to put the actual deals together and present them with all the creativity that we can muster about de-risking. And then once we get some examples, then we can start momentum.
Yeah.
Because as much as I'd like to think that giving these scenarios of what happens if we don't develop Africa, what happens if we don't respond to climate change, none of those things are going to work unless there's something that people can actually invest in. So when Angela says, we need to put things in front of her that will pass muster with her team. Now, we may want to go there and say, but look, the way you're thinking about risk is too narrow. Here's how we're thinking about risk, and here's how we're thinking about mitigating risk. Once we can start that conversation and put real deals in front of people, then that's when the momentum will start.
Well, I mean, it's probably a little bit off topic, but you look at the Congo, right? And the Chinese, if we don't do it, they're going to do it, because there's a brand new highway going from a cobalt mine with Chinese trucks to Chinese ships in a port funded by the Chinese on a brand new shiny road, because they're trying to take the cobalt, the rare minerals they need to build batteries, iPhone batteries, whatever, right? So there's also, I think, an element of, if we don't do it, maybe somebody else will, Dave, in some cases, where, it's again, impossible to quantify. Hero's you're never going to put that in an Excel spreadsheet, Hero, but there's a reason and a rationale to do it.
I don't know how to use Excel spreadsheet. I haven't used it for ages, but
I use Google Sheets.
But I mean, we talked about this, right?
Yeah.
What does the Japanese government think of GPIF as part of its overall effort to support the rest of the world? And I think the answer right now is not yet. Right?
Not yet.
Yeah.
Well, not yet for the most of the public pension fund. But to your question, I think that argument, actually very strong argument made by some people in Japan when I was serving on the Prime Minister's Council to discuss the long-term strategy for Paris Agreement. Some people, including me, trying to stop the coal power plant export, public financing. But the counter argument was, if Japan don't sell the supercritical coal power, Chinese will sell it anyway, right? So if that's the case, why don't we, let the development country a little bit better? I wouldn't say it's a very, very, much better, but a still cleaner coal power plant. And the other argument which raised has been always that they make a big, very strong case. If we won't do that, they will do it, and what we can do. And as a part of the G20 discussion on high quality infrastructure, one of the things which I know that the American federal government doesn't like the word of sustainability, but one other aspect of sustainability is the financial sustainability. And when we look at a lot of the Chinese infrastructure project, everybody came to realize that a lot of them are financially not sustainable, meaning the local government will find it very difficult to service the debt. So sustainability not only shouldn't be limited to the climate issue, but sustainability issue should be discussed that the old aspect of those infrastructure investment and the financial sustainability is the key, which I think some people like OPEC should play a bigger role.
Ray, is there a perfect funding structure?
There is not a perfect funding structure. Each of these geographies is a different geography. Each of these projects has got a different profile. I think some of the structures that have happened in the emerging markets have been informative, but there's not a specific structure that's going to fit. It gets down to the risk profile, where there's a construction risk, a market risk, an interest rate risk, an ownership risk. All these risks have to be taken into consideration on a project-by-project basis.
We're running out of time. I think it'd be kind of a fun exercise just to get to where your heads are at, because everybody on this panel is, is influential in this world, either financially, intellectually, or a combination of both. Dave, and I'll just start with you. I'll ask the same question to all of us. Why not, right? Because I'm being lazy. If you could do one big infrastructure project anywhere in the world, what would it be?
This might not.
But you have to make money on it.
Yeah, this might not count as your definition of infrastructure, but there's a $13 trillion opportunity to invest in the world's women, right? We are continually thinking about how to bring them into the economy, And while it's not laying concrete, I think it's building 21st century societies that's far harder than building 20th century infrastructure.
Binders full of women.
No, women
in your
empowered
investment
all over the
portfolio.
world. Women own, women manage, women empowering businesses all over the world.
Listen, just by definition, right? We just need the best, smartest people to be working. And, Hero, your country could learn from this, by the way. You get women in the workforce, and your GDP is going to do this.
Yeah.
Because you've had like 17 recessions in the last 20 years.
We actually have the female, the female working under the age of 30 than the United States. So we learned.
Good. Investing in women, that's a positive beginning.
But the one thing, can I just make one point?
Yeah.
I mean,
you got to think about your dream project, though.
Yeah, well,
Hero dreams of infrastructure.
My dream is.
You got that.
Yes,
Thank you.
I did. Thank
you.
My
dream is like, GPIF. We regard ourselves as the typical textbook definition of the universal owner. We own the capital market. We own about 10% of the Japanese equity market. We own about 1% of global, the equity index. And together with Alaska and those guys, all asset owners own the capital market. So we really cannot make an assumption. If we pick and choose the good project, it will save us.
Yeah.
We need to make sure whole the system or the world will be more sustainable. It's the only way to make our portfolio sustainable for long term.
We got to kind of boogie here. Dream project.
Dream project would be to turn the entire Sahel into a solar farm, and that the new sort of gold rush or the new oil rush would be the transmission of electricity either through batteries or transmission lines all over the world, and to be a source of income, energy, and revenue for some of the poorest countries in the world.
Angela?
So I'm going to back David first, and invest in his first. But the dream project I have is wireless transmission of power, and that is closer than we think it is.
Yeah, we need that because so much energy is lost in the transmission.
And so when we build that solar, we won't need transmission lines, and you can beam it to anywhere in the world that needs it.
Right?
5G technology and cybersecurity.
Fantastic. Hero?
We don't have a bandwidth to come up with dream projects. I pay to the asset manager to come up with something for us. And the two investment bankers too.
That's the problem with universal owners. We don't need we need more specific owners who will take ownership and put risk capital into specific projects, because there's plenty of debt. There's plenty of people who are willing to put debt in. But that's what's really needed in the world.
You guys
Real
were
owners.
great and big. I'm so ashamed of myself, because if you asked me the question, I would just say I want a new tunnel into New York. I mean, I'm so simple, and I want your Shinkansen high-speed rail to come to New Jersey, Princeton to Manhattan in 4 seconds, right? Because our high-speed rail is 46 miles an hour.
Yeah.
Guys, what a great discussion. Hero, Ray, Angela, Jim, Dave, thank you all for coming. Thank you to a great panel.